So why don't we just open it up for questions, if there are any from the audience? And I think there's some mics. Please, do we have... Someone mic up here first. You can briefly introduce yourself, where you're from.
David Yao, how are you? Thank you, Albert. Question for Kelly. The press played up quite a bit about shadow banking and wealth management products about 9 months ago. The whole thing is going to blow up. So far is now October. It doesn't seem to happen yet. So what's your comment on that?
Right. Okay, I'm still holding my mic, which is great. Yeah, the press goes in cycles of saying, "Oh, it's really serious," and then no actual major large-scale crisis occurs. I mean, there have been additional failures of various shadow banking, like trusts and investment companies and credit guarantee companies and things like that. And so I think it's important to keep in mind that the relative percentage of shadow banking relative to total bank assets and as well as a percentage of China's GDP is still quite modest. I mean, it's still just a fraction compared to the scale of shadow banking in the UK, the US, and the Euro area. Most recently, actually just I think yesterday, the IMF issued another report warning about shadow banking globally and made that same point that China is contributing to the growth in shadow banking. But again, we have to keep it in perspective that it's still a small percentage. It's something to keep an eye on, though.
Other questions?
Sasi Gopalan with the Institute of Emerging Market Studies. A question to Arno. Most of the literature, recent literature on financial inclusion, if you look at it, they've been trying to make this distinction between access to financial services and the use of financial services. So most of your talk covered a lot about the supply side barriers that we talked about, like geographical distribution, to overcome these constraints. So how do you think what could be done to overcome the demand side barriers, and from the household's perspective, cultural barriers, financial literacy to use such financial services are being provided? So just wondering if you had a comment on that.
Yeah, unfortunately, I will still focus on the supply side, because I believe the question of use of financial services is very largely linked to the fact that the products offered, the sophistication of the institutions providing financial services is very little and very low. So the products they offer are really not addressing the needs of the people. And because of that, basically, we compete as financial institutions trying to address or to deal with financial inclusion. We compete with the informal sector. And the informal sector is very flexible, very well organized, very tailored to the needs of those people. While we, as financial institutions trying to address, are not flexible, are not so well sophisticated, and are not, our products are not tailored to their needs. And till we, evolve in our the way we design products and we design services, we'll still have, a lot of competitions from the informal sector that we cannot beat. And so I think, and if you come back to the books I mentioned, The Portfolio of the Poor, in Bangladesh, a country which is supposedly, largely served by institutions addressing financial inclusion, out of the 10 informal financial instruments that most of this family will use, 1 or 2 will be provided by a microfinance institution. Which means that the clients are already dealing with the financial institutions, but they just use 1 or 2 instruments. The rest are still in the informal sector. The conclusion to me is that those financial institutions are not sophisticated enough and well organized enough to be able to capture and to understand the needs of those clients and define products according to those needs. It's still, in my view, a supply issue.
So maybe as moderator, I can also try to connect the two talks by asking a question of the speakers. So, Kelly, you talked about shadow banking in China. Arnaud really thinking hard about access of excluded groups in the financial market. And I'm so wondering, this whole shadow banking phenomenon and all the channels you listed, how do they influence who gets access to credit, and in particular, who is now being excluded? And are people at the bottom end of the kind of formal ladder being even more excluded now that a lot of the funds in the state banking system are being steered towards real estate and, you know, huge flows. Is this actually crowding out, making worse the access of smaller businesses or individual rural households? Is there an implication for thinking about access more broadly the way that Arnaud is framing it? And then for Arnaud, the one thing that struck me about Kelly's talk is that a lot of the resources really are in the big state banks, and they're all being channeled. You know, China had the stimulus, and the money kind of flowed through the system through very mysterious channels, but that's where all the funds were, and to really affect things, those are the funds that have the access. And so as a microfinance organization, can you really reach many of the 3 billion if you don't tap into all of the deposits in the big financial institutions? Because how do you just generate enough capital to really meet that need if you're not bridging to the big banks? So maybe you could start, Kelly, and then.
Sure, absolutely. Can you hear me now? Okay. I think it was better over here. Is this good? Okay, great. Yeah, great question, Albert. I think, ironically, the stimulus, because the stimulus incentivized state banks and all sorts of state-affiliated entities to start on lending, you know, engaging in all sorts of off-balance sheet activities, it actually became easier for private entrepreneurs, including smaller scale businesses, to get access to loans. And this is mainly due to poor regulation. And so you've got these you know, relatively modest scale businesses that could get loans from multiple sources and using, let's say, a vacant real estate building as collateral and collateralizing it several times over. And so that's actually greater access, ironically, due to poor regulation. I think the stimulus also expanded access to, well, really tapped into the middle class's desire for higher returns on their savings. And so they're becoming, I'm actually relatively sanguine about the expansion of financial inclusion among various segments of the population. What I'm concerned about, though, is the inherent risk, right? That it's not being properly regulated, and that, so, you know, people's savings could be wiped out in a second, and has been. Now, in terms of the lower end of the population, again, I'm relatively more sanguine because there's an unprecedented number of microfinance companies and these new what are called like informal finance streets or informal finance supermarkets or civil financial market. These are all the different ways they've been translated into English, like 民间金融街 or 民间金融 like supermarkets. So these have opened recently in Guangzhou, in Chengdu, in Xi'an, and there's like, you know, the entire street is just like these microfinance companies, investment companies, etc. They're able to lend at higher rates of interest to account for the increased risk of these small business borrowers. So I do see some expansion. Now, when it comes to rural credit and agricultural credit, that's another story. And I would say that there's still a long way to go because that part of the market is still, there are a couple of, you know, there's some NGOs, there's some poverty relief projects that are out there, and they just disperse the loans and they don't go to the right people anyway. I mean, there's a lot of corruption in the distribution of those loans. But in terms of urban borrowers and the middle class, I think access has never been greater.
So to address your question, I think we have to come back again to regulation, and you followed on the question you asked Kelly. I think you were thinking specifically about China. In China, obviously, as a micro lender, the current regulation doesn't allow you to get deposits from the public. And because you can't, obviously, your only way to have access to funding is to go to either to the banks or to the markets. For the moment, we go to the banks, and therefore we are limited in the way you mentioned. But this is, first, this is not only specific to China, but I will say that in the last 10 years, when I was mentioning the evolution of regulation and the improvement in the regulation, I was partly addressing this issue. No, I guess not all, but most of the emerging countries will offer microlender, a form of deposit-taking license and institutions. In fact, we have banks, we have financial institutions that we run and we own in about 10 countries today. There's just one country, China, in which we don't have a deposit-taking license. You know, from the Philippines to all over Africa, to even in Latin America, we have deposit-taking license. So, and in that cases, you know, when you don't depend on the banks, you have your banks and you can deposits from the public. In fact, as a very concrete example, in Kenya, coming back to this country, I mentioned the mobile operator in Kenya. But in the same time that Vodafone developed M-Pesa in the last 10 years, you had a bank which was in fact a cooperative microfinance institutions, 99, 2000, it was a very small cooperative microfinance institutions. We started working with them in the year 2000. I think in 2004, this institution had about, it's called Equity Bank. It had 150,000 clients, about $100 million of assets. It was just barely profitable. In the last 10 years, this bank became still focusing on microfinance or financial inclusion, became the largest bank of Kenya. It has now 9 million clients, 4 billion euro of assets, and it's about $5 million of profit every year. It's the first capitalization on the financial market in Nairobi. And all the other international banks, the large banks at the time, I used to live in Kenya 15 years ago, so most of the banks at the time, the Standard Chartered, Barclays, International Bank, and local banks, had the client deposit. But they've, you know, like most banks, they say, well, the small clients, we are not really interested. So they really didn't do much to attract the small clients. And therefore, when this small microfinance bank decided that its strategy should be to attract deposits from the small client, they got millions of clients, and small deposit after small deposits, they became the largest bank of the country. So again, it comes back to regulation. You know, if the central bank allow a financial inclusion-led bank to collect deposits, this bank can end up being the largest of its country, if it decides so. So it's not the case yet in China. It's not the case still in a few countries. In fact, in a large part of the Middle East, the regulation don't allow deposit-taking institutions. In a few countries in Latin America, like Argentina, Brazil, and Mexico, you cannot. But in most of the rest of the world, central bank will allow you to run institutions focusing on financial inclusion and taking deposits.
Do we have any other questions from the floor? Yes.
Yung Wang from Department of Economics at HKUST. So I have a question for Kelly. I'm very interested in the talk, state capitalism and shadow banking. My question is, given the inefficiency of China's financial institution, and you're talking about state capitalism, so what do you think is the most sort of effective way to reform China's financial institution, in particular to deal with any inefficiency associated with shadow banking under China's political environment? Thanks.
The interest rate liberalization has been discussed for quite some time, and I think that's probably the first step that needs to be taken. I mean, if the government can back off from financial repression and allow interest rates to rise to market levels, then that takes out a lot of the incentives that shadow bankers and informal financiers have for their practices. It won't eliminate it altogether, I'm sure. The financial entrepreneurs are very creative globally, not just in China. There's always going to be loophole mining of regulations, but start with the cost of capital, the official, the government regulated cost of capital. That's one step.
So, sorry, Professor, can I just go on for that? And fantastic speech, but I totally agree with that. But getting back to the first point you made earlier in your speech, which I think is prevalent, can the government bear the cost of reform? And I think with interest rate liberalisation, unquestionably, early on, it's going to be very, very detrimental to the large banks, or more specifically to the mid and small sized banks, with NIMS and bringing on NPLs. I mean, how do you think that,
that they can bear this cost, and if not, how long or how prolonged do you think interest rate reform will be?
Yeah, I just want to make sure I understand your question about whether the leadership can afford to deeply restructure the big banks and that it'll come at a cost to them.
Yeah, I think interest rate liberalisation initially will unquestionably be negative for banks from a NIM perspective and capital. So do you think that the government is prepared to take that?
Well, the center is proven able and willing to recapitalize banks at opportune moments, such as preparing state banks for IPOs and cleaning up their balance sheets. So China is in the fortunate position of having the resources and the foreign exchange reserves and the sovereign wealth funds to be able to do that for now.
My name is Albert Lee from The Good Investment Inc. Basically, we involved in shadow banking in China, but we also involved in lending to microfinance in Africa, to 10,000 families. But I think what our topic here is, financial inclusion in China are different from the financial inclusion in Africa or in emerging market, because the driver for the investor to the financial inclusion in China is because of the low interest rate in China, that people are looking for higher return. But when we are doing in Africa or in other emerging markets, that we are looking for social impact. So we are doing impact investment. So the whole objective are totally different. So why we are doing both? Because we want to get more money from Chinese market and then pull the money, the return into Africa, so that we can generate more social benefit. So we have to make sure that all the investment into emerging market for financial inclusion would generate some social impact and helping the people who borrow the money, rather than in China that we only trying to maximize our profit. So it's totally different issue. So would Arnold explain more about social impact and impact investment then?
Well, when I start, Planet Finance is a non-profit organization, and its only goal was to maximize social impact. And then, starting in 2003, 2004, I started to see this sector evolving from purely a social sector into a blended sector in which you could have both social returns and financial returns. And now most of the group, in fact, Planet Finance is still a foundation, but the foundation owns about 10 companies, which are for-profit companies, which I call social business, but in fact their goal is to maximize financial returns as well as to maximize social returns. And I strongly believe that you can do both. And in fact, in Africa, you were talking about China. I mean, our banks, the banks we run in China, are very profitable because of the specific situation you addressed. But our banks in Africa are very profitable as well, and even more in countries. I mentioned Madagascar earlier on. Our banks in Madagascar has about 40% return on equity, while it serves about 100,000 clients. And I can assure you that those clients, I'm there every couple of months. They are very happy to have us as a service provider, because they don't have other opportunities, and the cost of funds in the informal market is much higher than what we can provide. So I think you can both maximize social impact and financial returns, and that's what personally I'm very enthusiastic about this sector and financial inclusion, because I think we've reached a stage. I mean, 15 years ago that was not obvious, but now the institutions we run have become mature enough and to demonstrate that they can be a profitable investment as much as they can deliver social returns. And as long as you have a sector where, as I mentioned the numbers, you still have billions of people that are unserved. You really have a huge opportunity to address a social problem while you can still have interesting returns.
So I think it's appropriate to conclude our session on that optimistic note, that we can have both social impact and financial returns. And I want to thank everybody for coming today's event, and especially the two speakers. So thank you very much.